What's going on, everyone? Gilman with Wellthy Stocks, back with another video taking a look at a different option strategy, and it's by far my favorite option strategy. It's called vertical put spreads, also known as credit spreads. Now, typically when you're buying an option, right, you're buying a call, you're buying a put, you need a lot of things to go in your favor for that option to work out, right? So you're buying a call on Apple, expecting Apple to go up. As you guys know, Apple's not moving a lot right now. So even if Apple stays perfectly still, your call option is going to go down in value because a part of that option is the time value. On the other hand, with vertical put spreads, the way it works is the option can go, or the stock could go sideways, the stock could go up, the stock could even go down as long as it doesn't breach your put, and you will be fine. You'll make money. You can either make money with the stock going up, or you can make money by taking on some of that time decay, right? So we'll dig deep. We'll talk about some examples. I'll share some trades that I have taken on and my kind of the way I go about it and all that good stuff. So real quick, if you enjoy videos like this, don't forget to hit that like button down below. Subscribe to my channel if you are new, and comment down below what your thoughts on, the strategy are, if you do the strategy, if you're looking to do the strategy, and I'd love to chat with you guys down there. So let me hit record, and I'm going to focus a little bit more on my Tastyworks account rather than Webull, because Webull does not allow you to do spreads, and this does. So what are we talking about when I say spreads? Well, let me go to this is Spotify, and I took a trade on it recently, so I'm just going to use this for some of our examples here, right? So what we have here, I'm going to get rid of these for a second, right? So if you guys saw my other video that I just made about selling a short put, right? In that case, cash secured put. What you're doing when you're selling a put is pretty much saying, hey, actually, let me just go to Apple. I think the numbers might be a little bit easier to deal with there. So, or maybe Amazon, because I actually know what numbers to work with on Amazon. Okay, so I currently have a trade on Amazon, so we'll kind of talk about that. But pretty much, let's take another one. So if I were to go out and sell the 3,200 put, I'm basically saying that I would be willing to buy Amazon shares at $3,200. It's currently at $3,249. So if it were to dip below this number, I am willing to buy Amazon shares still at $3,200. Similarly, if I go to like Apple, for example, right, and I go to, March 12th, if I sell a 125 put, that's me saying I am willing to buy Apple at $125 if it goes below that number. Now that means that I'm pretty much taking on a whole lot of risk, right? Because let's say Apple were to go to $100. I'm still promising to buy 100 shares of Apple per contract that I sell at $125. So I'm losing $25 a share times the 100 shares that I buy, assuming Apple drops to 100. Now, Apple probably will drop to 100. That's an extreme example, but that's kind of what I'm saying. So in order for me to mitigate some of my risk, right, because I do still want to sell this put, what I could do is I could buy a put right behind it. So what I'm going to say is this S right here means I'm selling this 125 put, and this B means I'm buying this 120 put. And what that does is it pretty much, I'm going to actually get rid of this. Instead of needing $2,000, right, in collateral to put on this 125 put, now I only need $413. And what this is saying is I am giving someone the right to buy Apple, the right to sell their Apple shares to me at 125, but also I'm buying a little bit of insurance myself on the back end and saying, hey, if Apple does dip below 120, remember that you have promised to buy Apple from someone for 125. This right here is you having the ability to sell Apple to someone for 120, right? So what you're doing is if Apple goes now to 100, as it did in our previous extreme example, your max loss here would be $5 a share, right? Because someone can sell you their shares for 125 and you can turn around and sell it for 120. So even though Apple's at 100, so someone sells it to you for 125, you can sell it for 120, right? Losing this much instead of at the $100 that you would have lost otherwise. So that's why the strategy is great. Now, how do you make money in this strategy? Well, first and foremost, there's different ways you could make money. So as you know, this one is March 12th, 2021, which is about 3 weeks out, right? So you could make money in a couple different ways. Right now, there is a much greater chance of Apple dropping to 125, right, than there would have been if Apple was at 135, right? Because right now Apple's at 129.87, so it's only about $4 away from 125, right? Which means that's definitely more doable in the next 3 weeks for it to drop $4 than if it was here, right? So that's why you would get a little bit more of a premium the closer you would go, right? Because what you're saying is you're taking on a greater risk, right? And you're getting compensated for it, right? So there's a much greater chance that Apple hits 127 than hitting 125, right? So if you take on a higher put, that's more risk and you therefore will get more money, right? So if that's a little bit confusing, doesn't matter. Let's focus on how you make money. Now, for my current position, let me talk about a position that I have. The position that I have is this Apple position that I'm actually down $112 on, but I have until March 19th for Apple to be above $132.50. If Apple can go $2.50, today is February 20th. I don't know if you guys could see the date here. Today is February 20th, so I have pretty much 4 weeks for Apple to go above $132.50. If it is at or above $132.50, I get to keep whatever credit I got here. So let me look at the credit I got here for Apple. I got $1.40, which means I get to keep $140 if Apple is at or above $132.50. I know you guys see here and you see a lot of red. This week was a little bit of a pullback, and most of my winning trades I've already closed, right? So let's take a look at the trades that I've closed. I got into this Baidu credit spread on, let's see when I got in. I got in 219, I got $3.10, and I got out $2.12. Same day actually, 219, and that was a credit spread as well. Spotify was another one that I did recently. I got in 217 and I got out 219, and I went from getting $300 and giving back 182, so I got $118, right? I want to show you guys that although this looks a little bit red, I've closed most of my winning trades, and I have until March. If you take a look at this Amazon one, I'm down $37 out, $37 down on, but I need Amazon to be above $31.85 by March 19th. It's already at $32.49, so it's already like $50 above it. So I'm not too worried, right? That's the thing with vertical put spreads, is even though you see red in my account right now, in all these trades, I have until March 19th for most of them, right? Yeah, March 19th. I'm down $61 on this trade, but I don't care. I just wanted to cover that in case some of you are looking at all this red and going, wow, this dude is losing a lot of money. No, I've closed most of my winning trades actually in the past couple of days. And, you know, these trades that I took on were before a pullback, but again, because it's a vertical put spread, I'm not worried. So anyway, let's say you want to put on a new one. What you would do is, let's go to, Apple again, and you would say, I think Apple is going to be, actually, I'm not going to use March 19th because I already have a position there. Let's use March 12th. Apple is at 129. I think it's not going to go below 125. So what I'm going to do is I'm going to do this trade right here, sell a 125, buy a 120. This is not exactly a good trade for me because you're putting up $400, $413 to get 87 cents. My kind of rule that I look at is I want at least 1/3 the width. So if I'm selling a 125, buying a 120, the width there is 5. Therefore, I would want $165 at least. This is only giving me $87, right? So how do you kind of go about that? Well, one thing you could do is you could come up closer to this, right? Instead of selling that 120, 125, you could sell a 127, right? And move this up $2 too. So you still have a 5 wide. But now you're, again, still only getting $1.22. So the only trade here that I think would work would be this 128 and 123. But I think that's, again, that's a little bit risky because you are, getting kind of close to where Apple is right now. Apple's at 129.70s. You're doing 128. So Apple might not be the best thing to put a vertical put spread on at this moment. But if we go to a little bit more volatile of a stock, like what did I close recently? I closed Spotify, right? So let's take a look at this exact trade that I did. And so Spotify right now is at 364. When I put it on, it was at a lot lower than that, right? So let's take a look at, what this is. So in putting on this trade, what am I getting, right? Let's actually, this probably wouldn't be a good one to put on right now. Let me find a trade. So let's say I'm thinking, hey, I think Spotify right now is at 360s. I don't think it's going to go below 340s, right? So you're doing a 10 wide, right? Getting $2.75, which means that's the max amount of money you could make. And the max amount of money you could lose would be the difference. So in this case, by putting up this $10 credit spread, the max you could make is $2.75, which is $275. The max you could lose is $725, right? Because this is a 10 wide and you're getting $275. So the difference between $1,000 and $275 is the $725. The probability and the pop and the P50. P50 is the probability you're going to make 50% of your money, is 76%, obviously. The more down you go, so instead of selling at 340, 330, if you do 330, 320, your P50 is going to go up, but also you're going to make less money, right? So you have a greater probability of making 50% of your money, but at the same time, the credit is a little bit less. So that's what you have to do. It's a really nice balance between how much money you're putting up and what you're getting back, right? As well as, how slow it is. Typically, what I like looking at is a couple things, right? So I like looking at the IV. It needs to have high IV, which means the stock moves around a lot, right? If the stock doesn't move around, no one's going to really want to buy puts, and the price of the puts typically will be a little bit lower, so you're not going to get that credit. Second thing I look for is high probabilities, right? So in this case, if I'm putting up $1,000 to get 275, and my probability of making 50% is 75%, that's a pretty good probability, right? I like I like those odds. And I have, as you saw here, right? My Spotify trade that I took on 217, right? So let's take a look at the chart now. 217 is when I took on this trade. I'm going to go on the 5 days. So 217, let's see. Yeah, 217 right here, right? I put on this trade, and I got $3 in credit for it, right? So I put on this trade 310, 320, and I got $3 in credit, so I got $300. The next day I closed the trade and I had to give back $182. I could have held this Spotify trade until March 19th and gotten to keep the whole 300 instead of having to give 182 of it back. But I look for, 30, 40, 50%. What I want is a decent return on my money. But what I don't want always is to hold it until expiration, because, hey, Spotify could be doing absolutely amazing. And let's say the week of this March 19th, something could happen. Spotify could tank, the market could tank. And that's when I'm stuck holding, a max loss. So I closed trades on 30%. But pretty much what happened in this case is it ran, right? So I probably put the trade on when it was in the 340s. It ran up a little on Thursday. It ran up a little on Friday. Enough for me to get out making like 30, 40% in 2 days. In other cases, like let me take a look at another trade. I'm going to try to find one for us here. Let's take a look at, PDD. PDD is another trade that I put on. So if I go to PDD, we'll get an idea of when I made trades on PDD. So here, this trade I put on 2/9, right? And I got $1.42 for it, which means I got $142. And it took me a week to make $52. Some trades, not gonna lie, I have to go until March 19th. So this Apple trade, it might take until, you know, early March even before I'm profitable. But the reason I like trades like this, you guys, is if you were to put on a trade, you know exactly what you're getting yourself into, okay? And you have the max loss. So putting this exact same trade on right now wouldn't make sense, because again, you're putting up a lot of money for, you know, $1.80. So you're getting 180 for $800. So again, not a third of the width. You know, your max profit in this case is going to be whatever the credit you're getting is. Your max loss is going to be $820. Your probability you're going to make 50% of this money, which means you can make 90 bucks, is 85%. That's super high. Again, this doesn't have to work out, but typically, you know, it has a much higher probability of it working out. And that, you know, that's one of the reasons why I really like this. It could go, if you buy this and Spotify goes, in my case, Spotify ran, okay? That's why I got out of the trade in 2 days. If Spotify didn't run and I'm out of the money, which means I'm a lot lower than where the stock is currently, I get to eat what's called time value, right? So my option, a lot of the value of that, if it's out of the money, is the time value, right? Because I'm taking the risk that Spotify crashes between now and March 19th. So if Spotify goes up, I get out of my trade really fast. If Spotify does nothing, I get out of my trade over the course of the time as time value runs out. If Spotify falls, I have a whole lot of run room, right? Spotify's at 364. If Spotify falls, this is the line where Spotify is. It has to fall all the way to 320 before I'm even worried, right? So that's a $40 fall before I'm even worried. Actually, let's look at a different example. Let's look at one that is 2/3 of the width. So I'd probably put this on 340, 330, because I'm getting 275 bucks. Spotify has to fall $24, and I have until March 19th for it to go back up. So what happens if it falls? If it falls below 3, so the way you get a max loss, which means you lose the 725, is if Spotify falls below this 330 number. If Spotify is, so three scenarios. If Spotify is below 330, you go until March 19th and it's below 330, you get max loss of 725. If Spotify is above 340, you get to keep the max profit of 275. And if it's in the middle, in between these two, it depends on where it is, and then you kind of split between the profit and the loss. You know, if it's 338, your profit would still be 75. If it's 332, your max loss minus 200, right? So you could do that calculation yourself. But 90% of the time, I don't like holding until expiration, even though, you know, a lot of the times, right, in my Spotify case, if it's at 360 and my trade was at 320, I'm $40 away, right? But I don't want a market crash or Spotify crash to take away the 30-40% gain I have. That's why I like to lock those in. The other reason, you guys, is typically stocks go up and down, right? That's why I like vertical put spreads, is because if I'm buying now for a March 19th expiration, which is typically what I do, I go out to the next month because it buys me a little bit of time, right? If the market goes down this upcoming week, I still have 3 weeks for a little bit of a recovery, for it to get back above where I am, right? Typically in vertical put spreads, I get like two or three opportunities for me to exit the trade for a 30, 40, 50% profit. With a call or a put, there's so many different things that could happen. Your IV could get sucked out. You could start losing money because the option starts going against you. Maybe the option doesn't move fast enough. Here, being the seller of the options, it could go sideways, it could go up and you're winning. It could even go down. And as long as you're 340, and if Spotify goes down from 364 to 340, you're still chilling because it's not below 340. The only way you lose money is if it goes below 340. And at that point, you'd have to manage your trade or roll it to a later expiration, which is something that we could cover at a later date. So I know this might have been a little bit confusing. If it was, let me know down in the comment section, and I'd love to answer any questions you guys have. If you guys enjoyed the video, let me know down below as well. If you want more videos like this, let me know down below. If you have any questions, always let me know. If you enjoyed this video, if you enjoy the strategy that I share here, make sure always do your own research. I'm not a financial advisor, I'm just sharing what I see and why I really like the strategy so much. So don't forget to like and subscribe if you enjoyed. Let's remember to be a bit better every single day, and until next time.